Hello and welcome to our Prestige webinar titled Managing the Illusion Within the Illustration. I'm Shannon Griffin of the Society of Financial Service Professionals, and I'll be your moderator today. Prestige webinars are a new initiative from FSP designed to give our exceptional former national leaders and longstanding members a vehicle to share their expertise with fellow FSP members and the financial services community. Today's program is presented thanks to the generous sponsorship of Richard M. Weber, MBA, CLU, AEP. We extend our thanks to Dick for his sponsorship and continued commitment to the mission and ideals of FSP. Now, just a couple of quick reminders. This webinar is being recorded and all registrants will be emailed a link to the recording in about a week. Also, a PDF copy of the PowerPoint presentation is available. You can access the PowerPoint by clicking on the tab that says Handouts on your webinar control panel, or you can access the PowerPoint via the link that was in your confirmation email. Regarding CE credit, for today's live webinar, the credits available are 1 professional recertification credit and 1 CPE credit for accountants, and CFP credit was applied for but is still pending. If you requested credits when you're registered, a certificate of completion will be emailed to you in a week or two, assuming you successfully complete the webinar. Also, for accounting credit, be sure to make a note of the 3 CPE participation codes when they appear during the program. After the webinar, you will need to enter those codes on the evaluation in order to be awarded CPE credit. Those codes are only needed for accounting credit, not CFP or professional recertification. If there are any questions about CE, just send me a message to the questions tab and I can respond to you directly. And we will save time at the end of the program for any other questions. Just type them in the questions feature on your control panel as well. And now allow me to briefly introduce our presenters today. Dick Weber, MBA, CLU, AEP, is past president of the Society of FSP, and his background includes insurance sales, home office senior management, insurance software design and training, and for the last 20 years, fee-only insurance consulting and litigation support for high and ultra-high net worth clients. And Michael Lockridge is a chartered financial analyst, and his areas of focus include developing sophisticated methods to better assess wealth accumulation and retirement income forecasts, and life insurance as a non-correlated asset within a portfolio allocation strategy. Welcome, Dick and Michael, and I'll turn it over to Dick to get us started. Dick?
Thanks, Shannon. And again, welcome to our Prestige webinar. I'm Dick Weber, and with me today is my colleague and partner, Michael Lockridge. We're going to start with some background that may be helpful in confirming the ways in which highly regulated policy illustrations are very likely to lead to misunderstanding and missed expectations. We'll focus on an approach to a better paradigm, volatility testing, that goes well beyond FSP's historic volatility calculator, that HVC software that so many of our members were using until a few years ago when the Windows operating system was updated and the HVC stopped functioning. I'm going to turn off my camera so that we can get better bandwidth on the material we're going to show you. And then we'll both come back on camera when we get into our Q&A. And I hope you will have some good questions. Feel free to put them in the question area, even as we're going through our material. So by way of introduction, remember the good old days when Jim Anderson's job on the popular TV series Father Knows Best was that of a life insurance agent in the mid-1950s? That was when whole life was king when it came to the need for life insurance coverage. And of course, that's all there was. But one thing about whole life that we didn't give much conscious thought to were the intrinsic guarantees. They were so intrinsic that it was only in retrospect, after the introduction of current assumption universal life in 1978, that guarantees versus non-guarantees became any kind of issue. And with that hindsight, perhaps the most significant dilemma of current assumption universal life is the use of the word premium. In those good old days, we knew what that word meant, but with UL, there technically is no premium. It's calculated based on assumptions both inherent, like expenses, and specified, like an assumed crediting rate and the duration of intended coverage. That was a real paradigm shift, especially considering the customer's desire for lowest premium. More on the concept of paradigm shifts in just a few minutes. In 1980, with some UL carriers crediting 14%. And of course, that didn't last long, nor did the several carriers promoting that high rate. We could calculate the annual premiums from the illustration software. So here's an example. If a 43-year-old preferred female wanted to buy $1 million UL policy in 1980, and the agent allowed the momentary 14% crediting rate to be used to calculate a quote-unquote premium, it suggested a remarkably low $3,169 a year to create an endowed $1 million policy by her age 100. The problems, of course, began as crediting rates on plain vanilla UL began dropping. By 1985, crediting rates were typically 10%, and by 1990 had dipped to a range of between 7 and 8%. For our originally 43-year-old client, who's now 53, and with only $10,000 of account value rather than the originally projected $14,600 after 10 years, and even at the current 7% crediting rate, we get a very different in-force picture if the 7% crediting rate could be sustained for even just a few more years. In large part because of falling interest rates and a robust stock market after recovering from the momentary crash in October of 1987, variable universal life became the new current assumption solution, especially since it was regulated by the then NASD with an illustratable 12% gross maximum crediting rate. If our now 53-year-old became convinced she should switch to VUL as a better way to meet her goals in the face of the failing original UL, illustration software suggested a premium of $5,900 in this new policy with the $10,000 1035 exchange from the old UL and an assumed 12% gross crediting rate. And since a whole life policy would have cost her $20,000 or so, she figured she was still dollars ahead when it came to securing lifetime coverage. By the way, throughout the 1990s, when I was giving CE presentations around the country to financial advisors and agents, I would ask them what kind of insurance they were selling, and it was overwhelmingly VUL. And what crediting rate are you illustrating? I would ask, and the answer was overwhelmingly 12%. And of course I said, how come? And the answer was, because they won't let us use 16%. That was the typical answer. You'll see on the chart that's on the screen now, yearly returns in blue were favorable in this time frame, often incredibly favorable. The red bars indicate the rolling average, close to a 20% average annual return between 1987 and early 2000. So by the end of the decade, the agents using 12% rates to calculate premiums, they weren't wrong, they were just short-sighted. The problem with the first generation of UL was the agent and the client were essentially coming up with a premium based on a carrier's current crediting rate, not just for a single year, but for the 50, 60, or even 70 years into the future to a hypothetical age 100. No matter what you picked, and of course not more than the carrier's current crediting rate, it was calculated as a constant. Of course, the other factor to remember was the typical client was striving to pay the least amount of premium for the coverage they wanted. The unfortunate byproduct of that reality was the competition for who's got the lowest premium for a policy that doesn't have premiums. So it drove many producers to guessing the highest allowable crediting rate to drive the premium as low as possible and hold on to the prospect from the competition that might have suggested they had a still lower premium. With the rise in popularity of VUL in the late 1980s and throughout the 1990s, the problem became more complicated. Now we were guessing an average return in the selected allocation of subaccounts, again for 50, 60, or even 70 years into the future. And again, the regulated illustration software was using that guess as a constant accumulation rate against the reality that the market is never constant. I've written extensively about how the real issue has been the paradigm we've been operating under. A paradigm is defined as a set of assumptions, concepts, values, and practices that constitute a way of viewing reality for the community that shares them. From the very inception of the first generation of UL, and especially moving into VUL, the paradigm was we'll assume a return and then we can calculate the premium. And this was especially attractive to the many buyers whose own paradigm was pay as little as possible for their life insurance. As interest rates dropped from those early highs of the 1980s, many of you remember how we started running into some significant UL policy failure problems by the early 1990s. And in fact, there were at least a dozen class action lawsuits brought against major life insurers in the early 90s for the failure of UL policies due to much lower interest rates evolving since the assumptions made in the original illustration. Billions of dollars were spent in settlement and remediation of policies, yet the paradigm of using guesses to calculate premiums continues to prevail using assumed long-term crediting rates or now sub-account investment returns. We're all pretty much aware that with respect to these crediting assumptions, especially of the type of UL, be it original flavor, VUL, or now IUL, constancy of crediting projections is a huge issue that, especially when the second part of the paradigm is to minimize premiums, creates real problems for the consumers and the professional agents who are trying to do the right job for their clients. Well, you might say, okay, let's just use a lower than current projection of crediting rates as the basis for calculating premiums. That should do it, right? Well, even in the more conservative projection of VUL returns at 10% rather than 12%, and remember, this is 1990, we have to ask, what's the right premium for our 53-year-old female? And whether it was her consideration of $5,900 a year at 12% or $7,500 that could be calculated at 10%, it was still going to be flawed and end up disappointing. Why? It's back to that problem of a constant projection and calculation. We subjectively know that a premium of $7,500 will have a better likelihood of making it to become a death benefit than that lower $5,900 premium, but that's still 38 fluctuating years in the future, just to her average life expectancy of 91. So here's our premise. Let's change the paradigm. Instead of trying to serve the client's desire for the lowest premium I can pay, often compelling us to use a higher constant return assumption than is likely appropriate, what if we got out of the guessing game business? Instead, what if we ask the client the question, when it comes to life insurance with flexible premiums, what's your risk tolerance for variability and the potential for higher premiums to maintain the coverage at some time in the future if you've started out, especially with the lowest possible premium? In other words, what's the minimum probability of success you would assign to assuring this policy fulfills its promise of a death benefit no matter when you die? In the early 2000s, when we started posing this type of question, the paradigm shift, if you will, the response often ranged from 80 to 90%. And there were some 100% responses. After all, it's life insurance. Perhaps not surprisingly, as I continued to ask that questions to audience of planners and producers, I started getting less aggressive answers after the economic collapse in 2008. 90% became the minimum response, and 100% was much more common. After all, it's life insurance. So before Michael and I joined forces and he replaced the HVC with new heights of comprehensiveness and usefulness, here's what I developed as a way to convey what we were suggesting when we use probability of success rather than assumed returns as the basis for calculating premiums in the face of few guarantees around the sufficiency of the premium you are going to pay. So here's my relatively simple way to explain it. When we dove beneath the surface of the calculated and relatively attractive $5,900 premium using the 12% long-term accumulation rate for an 80-20 asset allocation into a VUL, we discovered there's a 92% probability of lapse before age 100 when exposing illustration inputs to 1,000 random variations of historic market volatility in our client's chosen allocation of subaccounts. And the first lapse out of the 1,000 randomly generated outcomes occurred at her age 75. And we assume that's not a satisfactory outcome when looked at from that standpoint. It's worth noting that the statistical average life expectancy of a healthy 53-year-old woman is age 91. That means that half of a large group of today's healthy 53-year-old females is still alive at age 91. So let's see what it would take if we increased the initial premium to reduce the odds of the policy lapsing before you do down to 30%. 5,900 to 9,800, but a substantial shift in the probability of success, or down to 20%, or down to 10%, or down to the premium that would virtually eliminate the odds of failure. By the way, it's interesting to note the implied illustration rate of these various levels of initial premium. We know that 12% produced a very low $5,900 premium. But to get to that very small chance of failure, the illustration rate would have been approximately 4.4%. So now it's time to get under the hood of the regulated universal life policy illustration and move on to the popular use of indexed universal life and the issues of volatility in the real world, recognizing they're very different from the illustrated world. For this, I'm going to ask Michael to take it from here. However, for those tracking CPE credits, here's your first code to include in the program evaluation. So CPE code number 1 is the word illustration. Mike, it's now over to you.
Great, thank you, Dick, for that. As we have already seen, a constant rate illustration can be very misleading and lead us down paths of who can illustrate better, with the appearance of lower premiums and better policy cash values, etc. The idea of probability of policy success and failure has not been fully explored yet. However, looking at policy performance projections in this way allows for a more robust discussion around questions like, what is the impact of variable and volatile crediting rates? What is the impact of changing non-guaranteed assumptions, for instance, like IUL cap rates? How does average life expectancy fit into our exploration of policy performance and chances of failure? Maybe we need to look at these policy projections in a different way. Dick talked about the life insurance industry's paradigm shifts that have led to things like disappearing defined premiums, policy account value accumulation exposed to market volatility, and the introduction of non-guaranteed elements that impact policy performance. All this now drives the need for ongoing policy review and management. Why? Well, now who bears the risk of the policy performing? It's the policy owner, who expects that the policy's purpose and plan of execution will be met. But what is the risk of failure and how tolerant are you? Isn't this insurance? Many clients don't understand the balancing act that now needs to be considered in more detail and with more diligence. We'll be looking at 2 examples today. These are based on actual situations and actual policy illustrations. Though of course, some of the information has been changed or not shown for confidentiality reasons. As a note, we are not running new illustrations. What we're doing is taking an actual illustration and analyzing it, contextualizing it, and showing varying scenarios in order to highlight the impact of certain non-guaranteed elements and the inherent volatility that exists in the crediting methodologies of these policies. So with that said, let's talk about Ben. Ben is 52 years old, and he and his wife already have several policies for themselves, but they're looking for $1 million death benefit policy for their 2 children. He had an illustration run on himself as the insured that focused on the minimum premium needed to achieve his expectations, specifically $1 million of death benefit until at least his age 100. He's generally happy with the illustration, but because it is very important to him that his expectation will be met, he's looking for a second opinion. So let's just look quickly at this policy. Ben decided on a variable universal life policy for protection only with a death benefit of $1 million. The policy is just on himself, and it's a new illustration, so we are in policy 1, year 1. And he has been through preliminary underwriting, and it's looking like he'll get a standard non-smoking rating. By the way, he chose a VUL because he was told that he could have the policy account values allocated to sub-accounts that looked like his investment accounts. This gave him a sense of familiarity. He understands these account types. His investment risk tolerance is moderately aggressive, which equates to about a 60-40 equity to debt portfolio. However, he has no insurance risk tolerance. In other words, his expectation is that when he dies, this policy will pay out the $1 million, period. Looking at the current cash flow expectations, the illustration shows no income or policy loans assumed, and that it was run at a 10% constant rate. We know from earlier in our presentation that there's a relationship between the rate the illustration is run at and the premiums needed to keep the policy illustration performing and enforced to age 100. The solve here was for $5,000 a year for the entire projected period. This resulted in about $240,000 of total projected premiums should Ben live to age 100. Looking at the projected policy values, we see the account values, which are the green bars, accumulate and grow to about age 90 and then begin to decline. The decline, of course, is due to the yearly increasing costs and charges, mainly the cost of insurance. This decline happens despite the constantly compounding growth rate assumption of 10%. And we see that just enough premium was assumed or solved for, so that by age 100, there is virtually nothing left in the policy account value, but it has not lapsed. The death benefit, the blue line, is still projected to be there. This is what we might call a thinly funded policy. The constant rate projection shows us a 0% rate of failure, and so a 100% probability of success for all years to age 100. So everything seems fine with this. But now let's look at what happens when we introduce volatility to the assumed crediting growth rate. Ben had assigned the allocation to the VUL subaccounts along the lines with his investment risk tolerance, hence the 60% allocation to equity securities. In order to assess the probability of success and failure, we look at 1,000 possible future projections of how the subaccount portfolio will perform. To do so, we have to account for a well-defined distribution of possible outcomes, and even more importantly, the dollar sequence of returns. So let's see what happens when we move to a volatile rate assumption and run 1,000 possible futures. We immediately see that the constant rate, which produced a 0% failure rate, now is more like a 95% failure of lapse by age 100, viewed through the lens of volatility. All we changed was the crediting rate assumption from constant to volatile. Looking at the probability of success chart, we see that the bars turn red when less than 100% probability of success occurs. They show an aggregation of failures per age. So if only one of the failures occurred by age 80, then that bar will show 99% probability of success, and so on. There is a rapid decline in success probability, and by age 85, we're below a 50% probability of success. And by age 100, we're at 5%. Let's take a closer look at the policy failures in more detail. The histogram of policy failures shows us that out of 1,000 possible projections with a volatile rate, 950 of them fail. In other words, result in a policy lapse. But when do they occur? And what does this mean in the context of Ben's average life expectancy? Given Ben's assumed health rating, his age, and gender, we derive an average life expectancy of 85. We can see that the earliest failure is at age 79, and half of all the failures occur by age 85. Half of all the failures, so 475 out of 1,000 possible futures fail prior to his average life expectancy. Ben is not happy with such a probable risk of failure for a simple policy that is supposed to get his children the expected death benefit when he dies. So what can we do to help improve the odds of success? Well, first off, understanding now that there's a probability of failure. Remember, this policy is not guaranteed, and Ben is beginning to understand that. It is his risk to bear, and notwithstanding his original expectation of a 0% risk of failure for his policy, Ben is now willing to accept maybe a 10% failure rate that could be okay. Given that, we'll try a 50% increase in the annual premium to $7,500, and that results in a 15% rate of failure. We can see that the success bars now turn red when the probability of success falls below 90%. In other words, the failure is greater than the 10% rate that he would allow. Although we still have not met the max failure rate, let's see what we've already accomplished. Before applying the change to the premium, we had half of the failures occur by age 85. Now the first failure by age occurs at 87, and half of the failures, 75 of them, occur by 95. Of course, just as a reminder, Ben's average life expectancy hasn't changed, right? It's still 85. At a 15% failure rate, we were close to the objective. So what we'll do is we'll just increase the premium a little bit from 7,500 to 7,750, and we see that we meet our objective of a max failure rate of 10% to age 100. Ben will stick with his VUL policy choice, but will increase the assumed premium outlay, and now knows that he must analyze the probabilities of success and failures on an ongoing basis and get an early read as to how to manage the policy as time moves on. And actual policy performance begins to show up in the future in in-force illustrations that he will have produced. At this point, let's just take a quick aside and talk about projections with volatility and uncertain future growth rates. Remember, I mentioned a few minutes ago about dollar sequence of returns. The problem is we don't have a crystal ball. No one does. The past can be a guide, but not a map. And although business and economic cycles may repeat, the timing is unknown. However, we can use historical performance to gain insights as to what to expect from future performance. We'll use Ben's example to explore what this means. Performance of the 60/40 portfolio per Ben's allocation has a distribution from 20 years of historical data with a mean or average return of 7.16% and a measure of dispersion or standard deviation around that average of 10.39%. For 1,000 projections using this distribution of returns, this gets us this expected crediting rate charge, where each age is an average of all returns that occurred at that age for all of the 1,000 projections. This can be a little hard to wrap our minds around as to what that means. So let's just take a look at one of the 1,000 possibilities. One possible set of crediting rates that would be run for Ben's lifetime may look like this. It has rates going from a high of almost 28% to a low of almost negative 20%. These are the potential negative crediting rates that would impact the projection for this single possibility of projections. Here's another possibility with a high of almost 42% and a low of negative 28%. And another possibility with a high of almost 29% and a low of negative 11%. The point here is that we have an idea of the overall description of the distribution of possible crediting rates that could occur. We just don't know the timing of when they will occur. But applying the idea of dollar sequence of returns to the inflows, costs and charges, and crediting volatility of the policy, we can generate an aggregation of probable outcomes for 1,000 possible futures and get results that give us the probability of whether the policy will succeed or fail and an idea of how this may play out over time. So as a quick aside, here is the second of the 3 CPE codes. It is Weber. The second CPE code is Weber. Let's move to our next example. Sally. Sally was issued an indexed universal life policy at age 53 with a preferred health rating. The IUL policy was designed for accumulation in retirement income from age 70 to 90, which is 21 years. This is a significant part of Sally's retirement planning, and she is counting on this income stream. She just turned 65 and had an in-force illustration run for her. With the changes that have occurred to the policy and to the rates that this policy can be illustrated at, Sally is now quite concerned that the income that she's relying upon won't be realized. But she does not understand why, or more importantly, what to do about it. What is within Sally's sphere of control and what is not? She is only now beginning to realize that the risk of the policy performing to her expectations is all on her. Reviewing the high-level description of the policy, it's an IUL for accumulation with a death benefit of $1.27 million. The in-force illustration is in its 12th year, and that's Sally's current age of 65. She's already put in about $590,000 of premiums during the earlier years of the policy, and she isn't planning on putting in any more. The total retirement income planned is for just about $2 million to be drawn as policy loans over the 21 years. That $2 million means about $94,000 per year from age 70 through age 90. At the time this policy was issued, which was 12 years ago, the illustration rate was a constant 7.25%. Running that constant rate, we get a policy probability without any failures, all the way to age 100. However, this is an IUL tracking the S&P 500 point-to-point return, not including dividends. So what about the volatility that would be experienced? At the time of issuance, the cap rate for this IUL was 12%. So what if we ran this with volatility, even using the original assumptions? We get a 32% probability of failure, which by Sally's age 90 means a probability of success less than 70%. Remember though, this is still using the assumptions per the original illustration of 12 years ago. So let's update them. We'll use the current in-force illustration that Sally had run for her. The current cap rates have fallen by 500 basis points, from 12% down to 7%. This, by the way, is not an uncommon experience, especially in the last few years, right? You guys have probably seen this and experienced this. Sally, now appreciating that there is a projected success and failure rate for her expectations, is willing to accept a 10% failure rate, but not more than that, as she's really counting on this income. I'm not going to show the results of running at the constant rate of the new constant rate to save time, but note that the maximum in-force illustration rate that now can be used is currently 5.25%, which is down from the original 7.25% from the sales illustration. It was this change with the in-force that initially has caused Sally to have concerns when she saw what was going to occur with that in-force illustration. Let's look at projections now at the 7% cap rate. The result, a 97% probable rate of failure, and the probability of success bars go red when not meeting her max failure rate. We can see that we are below a 50% probability by age 85. Let's get a more granular view of the probability of failure. Note that based on Sally's health rating and gender, she has an average life expectancy of 91. The earliest lapse occurs at 81, and half of all the lapses occur at 85. All lapses occur prior to her average life expectancy of 91. Let's just note here that if the policy lapses prior to Sally's death, there are some pretty negative consequences. Mainly, all the income above basis she has drawn as policy loans could become taxable at ordinary income rates. This is, to say the least, not an optimal outcome, and it highlights another useful element of analyzing the probability of success and failure rates for her plan expectations. Remember that she is expecting almost $2 million of income draws by age 90, and there's a 50% chance that she will outlive that average life expectancy of age 91. Let's look at the policy values and put those in the context of her average life expectancy. Before we do that, however, notice the death benefit shown as the blue line. It begins to decline as income in the form of policy loans is drawn, which results in the death benefit net of the outstanding loan amount. We can see where the earliest policy lapse occurs in the context of the policy values and death benefit amounts. This is at age 81. And 2, where half of the failures occur by age 85, and finally, by average life expectancy at age 91. This is, of course, not showing a very healthy picture. To get a sense of one way to get us back to a more probable outcome that is in line with her maximum failure rate objective of 10%, is to lower the income expectation. Now, this is not optimal, as she is relying on this income, but the sad reality is that she may have to lower her expectations. Let's try lowering the income from 94,000 to 72,000. This is about a 23% drop. But that does get us to Sally's max failure rate. And we can see the probability of success bars reflect this 90% success rate out to her age 100. Looking at the resulting policy values and death benefit projections, we see a much healthier picture. Although we still see a decline in values by the earliest failure at 84, and half the failures now, which are now at 89. And there's still significant policy value by her average life expectancy of 91, where she is projected to have halted her income draws, and the policy then begins to pick up value and even increase in the expected benefits by age 100 to surpass her original death benefit of $1.27 million. But her total income projection is now $1.5 million, which is about $500,000 less than her original expectation. And though her income period is still the original 21 years from her age 70 to 90, this leaves an outstanding question. Given her average life expectancy of 91, what is she planning to do for income in her 90s? It's not unreasonable to assume that she could live to age 100 or even beyond. For Sally, the story has really just begun. There's potentially much more planning and decision-making that is going to have to take place. But knowing the areas that she can control and having an appreciation for the way her expectations are impacted by those things that she can control, in addition to the things that she knows are out of her control, i.e. the non-guaranteed elements, Sally at least now understands the situation and has a sense of what are the things she can do about it. She understands the moving parts. Rather than just giving up in frustration and confusion, Sally and her advisors are more able to discuss options to manage the shortfalls of her plan. Advisor and client working together with ongoing policy reviews and analysis can continue to modify her plan and her expectations as needed over time. Is Sally more confident in her ability to make decisions? Is she better served? With modern life insurance policies subject to market volatility and changing non-guaranteed elements, the risk of policy performance is squarely on the policy owner. To have a high probability of meeting the policy's purpose and the expectations that the owner has around premiums and benefits, she has to realize that it is a balancing act that needs ongoing review and management. This level of needed analysis is unfortunately not available with today's regulated life insurance policy illustrations.
Thanks, Mike, and especially for taking us through these two assessments. And hopefully we've met our presentation objectives of demonstrating the impact of volatility on today's life insurance policies, seeing how to understand and explain the impact of changes to an illustration's crediting rates and cap rates, learning how to contextualize average life expectancy, and managing client expectations, having a dialogue with clients about their insurance risk tolerances and the need for the more sophisticated ongoing policy reviews and management that would be allowed by a conventional in-force constant rate illustration. Mike, you also raised a number of issues that are worth exploring a little further. For instance, for Sally, although she now understands the nature of her problem and is prepared to adjust her expectations, she hasn't solved an important issue that you've addressed, which is that she has a 50% chance to live beyond age 91. And even her original plan didn't seem to address that she could need income well into her 90s. Could she do some other things like look at additional premiums to pay in now, or delay her income, or even extend her income into her 90s?
Yeah, so definitely. So when we looked at this, unfortunately on the premium side of things, the options are fairly costly. She's 65 years old and just 5 years away from when she wants to start these income draws. If she had looked at this even just a few years ago, the cost may have been more acceptable and doable given her other financial resources. But today, if she paid additional premiums for the next 5 years, so from 65 to 75, it would take an additional $75,000 a year, or a total of $375,000, on top of the original $590K she put in already, just to get her to that 10% max failure rate for her original $2 million income plan expectations. Now, if we didn't look at additional premiums, she could instead consider waiting or delaying her income. For instance, if she had other resources to draw upon until her age 75, and then look to take income all the way out until age 100, so that would meet that in the 90s problem that she has, she could potentially draw $100,000 per year for a total income draw of $2.5 million, which is 4 more years than what her original draw schedule was, and $500,000 more than her original expectations. This would potentially get her income all the way through her 90s to age 100, and all we did was delay for a few years. This, of course, assumes she has other resources, but we use this analysis in order to be able to demonstrate that this was one of the potential options that she could choose or pursue. Alternatively, if Sally just wanted to extend her income draws from age 90 to 100, she could just drop the income amount a little further. We were at 72,000 before. If she dropped it to 70,000, then she can still meet her 10% failure rate. But now we have income going all the way out to her age 100. And so this has increased up to 2.2 million, which is more than her original expectation. And she met this age 90s income problem. Of course, if she died at life expectancy, right, the income not taken will still be there and will come out through the death benefit. There also could be a combination of a little more premium now, a delay for a few years to the start of her income draws, and a slightly lower income level to get her to age 100. The point is that we can now look at these different scenarios, present options, present different ways of sort of tackling the problem, and get an idea of where vis-a-vis probability of success and failure falls. How do these different options result in their future potential probabilities?
Thank you. So I think we've really seen the value of that paradigm shift away from guessing rates of return, notwithstanding the fact they're going to be used constantly by the illustrations, and moving to the better paradigm of what's your required probability of success and, of course, failure. So Sally and her advisors have the ability to analyze different options and go with a modified plan of expectation that works for her. And of course, Sally and her agent or advisor will want to closely monitor the policy's progress over the coming years, managing current assumption life insurance as they would any other asset. So we want to, just before we start taking questions, we want to call out the third CPE code, and that is simply numerically today's date, 03-02-22.
Yeah, and if you're interested in exploring how to access this analytical tool, you can go to lifeinsuranceanalytics.com and register for an account. For registering, you get a free analysis. We call these report cards. These are life insurance sustainability report cards. For attendees of this webinar, you'll get a separate email to register, and with that comes an additional free report card to run your analysis. If you're looking for any consultation for a particular situation, you can find out more about our consulting services and reach out to us at ethicaledgeconsulting.com.
Great, and of course, thanks to our attendees for your interest in this important topic. And so Shannon, we're ready for questions from our attendees.
Okay, great, thanks. And there are quite a few already. The first question, this one came in earlier in the presentation, and it is, why do insurance companies not illustrate the annual historical rate of return?
That's a great question. When the NAIC finally put together its illustration regulation in 1995, that's a long time ago, there wasn't that much attention on the kinds of economies that could produce negative returns. Remember how things were going in VUL, especially a lot of very positive returns. We'd been through the UL dilemma, but frankly, the amount of marketed UL had shifted to VUL and even no lapse products. So I think the attention hadn't been focused on what volatility does versus the constant rate tradition that had been built into the illustrations. We have been urging the NAIC to take volatility into account. Unfortunately, there doesn't seem to be much appetite at the moment to open up the review of illustrations, especially for IUL that didn't exist in 1995. Certainly wasn't part of the major marketplace. So that's kind of the dilemma. I hope that answers your question.
Okay, great. And how does the software take into account of different carriers' expenses ratio, which also has guaranteed and non-guaranteed rate, and every carrier is different?
Mike, that's a good question for you.
Yeah, so that actually opens up a couple topics, but what we went through today was a scenario analysis of our benchmark report. We have online, there's an easy way to get an assessment relatively quickly, which uses a benchmark of costs and charges. What we did is we went out into the market and got for the top 20 carrier and policy types of different things we got, what their costs and charges were. And that is what's laid into the benchmark report. The other side of what we offer is something called a customized report. And what we do there, it takes a little bit longer because we have to pull in the data from the illustration that you upload and provide it to us. But in that situation, that is bringing in all of the current assumption details of that particular carrier and policy illustration. So we have all of the underlying details for that, and you can run analysis around. And that is what we call our fully customized version of this.
And I'm very pleased to point out that as Mike was working on the report card with the, I'll call it generic pricing of the top products in the various categories, IUL, VUL, et cetera, that when we actually compared the generic or the benchmark figures to real illustrations, they came in very close. So we're quite pleased with how that's been working. Any more questions, Shannon?
Yes. What is average life expectancy versus life expectancy?
I'll tackle that one. So life expectancy really means average life expectancy. It is the assumption that the actuarial community makes, taking 1,000, 100,000, 1,000,000 very similar profiles by age, by gender, and by health, and projecting the likely number of deaths over time. Deaths will start occurring right away. It's the point at which half of that original group members have died. That forms the age of the average life expectancy. And of course, it's at that point where half of the original group is still alive. So unless your actuary is named Soprano, and I actually ran across an actuary named Soprano, we can't tell you who is going to die, of course, but the science, actuarial science, is really amazingly accurate about the number of people who are going to die. So average life expectancy is simply the point at which half of the original group have died and half are still alive.
Okay. Let's see. Lots of questions, just trying to.
Sure.
Okay. How would some of the overloan protection riders help with this income situation?
I'll give a quick answer and Michael may have a backup. The dilemma with the overloan is that a lot of people assume it means they can continue taking the money that was suggested in the original illustration. And that's, of course, not what the overloan protection does. What it presumes to do is reduce the policy down to a point where, with a much smaller death benefit and any remaining cash value, that the policy will remain in force. The dilemma is that strategy has not been tested with the IRS. And in essence, and this is just my personal view, in essence, what we're talking about is loan forgiveness. And we know that loan forgiveness is usually taxable. So I think the dilemma is it's an intriguing feature that hasn't been proven out yet and that has many stipulated requirements in order to be able to invoke the overloan feature. So it's not every situation that can even use it, even if it's on the policy, and even if it is going to pass the smell test with the IRS in terms of forgiveness of loan. Mike, anything that you would add to that?
Yeah, no, I just want to add one, and I'm not going to speak specifically to the details of that one, but I want to just talk about some of these riders that are intended for protecting the client with regard to the performance of the policy. It's not that we're saying that they're bad or that they don't work. The problem is the timing of when you get the notification of when to do something about your policy. It only happens when a problem is about to occur. So, you know, the worst thing you want is you're a year away from your expectation of your next income draw, for instance, and you get this notification that no, you can't take that income or the policy will lapse. Or if you want to take this income or leave the policy in place, you need to put in all this additional premium. And so this is all happening in real time, right at the point of, if you will, the cliff. And what you want to be doing is getting way ahead of that so you never get to the cliff. So you have the ability to foresee what's going to happen or potentially could happen and deal with it then. Because when you deal, and trust me, we've dealt with some situations where people have gotten that notification and saying, hey, to keep this policy alive, you're going to need X amount of premium. The problem is that amount of premium just covers the cost of insurance for the next year. And it's a big number. Well, what about the year after that? And the year after that, and the year after that. So it becomes this really difficult math game and decision matrix that you have to say, at what point is it no longer worth me continuing to keep this policy alive, given the death benefit expectation or whatever. And that's, you know, that's kind of like the last, you know, you don't want to be in that situation. You want to be dealing with this before you get to that situation.
Yeah, you want to get ahead of it, ahead of it. Good, thanks, Mike. Shannon?
Okay, yeah, a couple questions about the software again. This is what system is being used, and then another question is where can I get the software he is using?
Well, thanks for asking, and not to be a commercial, that was not our purpose in putting together this webinar, but yes, it is software, yes, it is available. Unlike its HVC predecessor, the Lisa tool is available online. And there's a variety of ways to affordably run a few or many of what Mike has called life insurance policy report cards. So you can go to lifeinsuranceanalytics.com, but as well as an attendee of today's webinar, you'll shortly receive a custom link that will provide you with a complimentary policy assessment report card, in addition to the free one that comes with registering on the site. So people who come to this presentation will actually get 2 free report cards. Thanks for asking.
Okay. Let's see, for my company to run in-force VUL illustration is a pain and must send requests to home office to get one. Among all the carriers, have you seen carriers provide outstanding illustration software than others?
Well, kind of the predecessor answer to that is the problem with any illustration, and it's not the fault of the carriers. It's simply the way the regulations drive the practical implementation of illustrations, is they're all produced at constant rates. And I think we've been able to demonstrate how constant rates can be very deceptive in terms of what I'll call the trajectory of the policy. So in that regard, no, I would say no one is producing a good VUL illustration, not because they're intending not to, but because of the very realistic reality of how a VUL, whether it's a sales illustration or an in-force illustration, when it's constrained by a constant rate, you're simply not getting the information you need to, again, understand, is that trajectory going up, like the classic need of increasing cash value and decreasing net amount at risk, or is it going the other way? Mike, anything you would add to that?
No, I would just say that, yeah, I mean, we recognize that part of the problem is the carriers can be very, to be nice, can be a little bit slow sometimes in generating some of these in-force or new update policies for you. We tried to design the benchmark so that with the least amount of inputs, you'd be able to get some kind of an answer of what this policy looked like. So if you had an account statement, for instance, which usually just gets produced annually, at minimum annually, and will have things like current policy value and current death benefit, what year the policies, you can run a benchmark. You will have to have some idea of what the age 100 values might look like. So that's kind of the difficult part if you're not actually looking at an illustration, at a new run illustration. But it would be possible for you to go there and get some kind of an answer. I would just like to note, though, on that, I promised I wouldn't make that type of a caveat, because the point of this analysis is not to be trying to create a new illustration. It is not illustration software. It is meant to analyze an existing illustration. That is a very important distinction to be made.
Yeah, and existing meaning it could be a newly proposed policy, or it could be an in-force policy. Probably the in-force management has always been my consideration of what's most important about looking through this different kind of lens, is we've got to actively manage these policies as any other asset. Shannon, any more questions?
Yes. Do most illustrations include projection with a breakdown of all charges on an annual basis?
No. Very few carriers provide that particular ledger table or tabular table as a usual set of the illustration. A lot of carriers, you can request it. You can specifically ask for the policy charges and credits pages, and then they will provide that for you as part of the illustration. So you have to find out whether they A, provide it, and B, then you have to request it. Or if you can run it yourself, you can choose that as an optional set of pages to be part of the illustration.
And that's really an important thing to understand, is a lot of carriers do make available what we would call an annual expense breakdown included implicitly within the illustration. But often the agent is given the option of running it or not. And our general view is, I think it's very important disclosure for the client, but even more importantly, in terms of the LISA that we've been demonstrating, life insurance sustainability analytics, is that you can run a customized version that will require that expense detail. That's probably the major additional piece of information that's required. And then the LISA analytics can really accommodate at least the currently illustrated factors of COI and premiums charges and all the other things that go into it. And on IUL soon, we'll be able to look at those multipliers and other features in the customized version of LISA. So thanks for that question.
Okay,
Anything
yeah.
else, Sharon?
Yeah, this question was about the customized version. It says, is your customized version able to accommodate multipliers, bonuses, and different index account options?
Mike?
Yeah, so the customized version does have a lot of variability. The place where it shows up is in the scenarios to be able to run different scenarios. And in fact, there have been some instances with Dick and I working on a particular project where it was an IUL, but when we looked at what the crediting options were, the crediting option choices that were available and that were given were really actually acting more like sub-accounts, more like a VUL. So we actually switched the policy type to VUL and ran it that way. As far as multipliers and things like that, we are going to be bringing in a proxy for the multipliers. You know, I think just one of the biggest issues is very quickly on that. You know, what people forget, I think, with those is that the cost side of the equation of the multipliers is all up front. You pay for the hedging strategy and you pay for the 1 times, 2 times, 3 times, 4 times hedging strategy. You pay that up front and you pay it regardless. And the policy, that is a cost to the policy. On the crediting side, you get the bonus of the 1 time, 2 time, 3 time, etc., depending on how the actual underlying assets perform. The tracking account, these usually just track the simple S&P 500 point to point. So if it had a, you know, if you hit a good year, then yeah, a 2 or 3 time multiplier could look great. But in those years where you're at the floor, you're getting no benefit, but you've paid all the costs. I just wanted to make that as a quick question. And I don't know if we have time, but this did kind of just open up one other quick issue, which is around the new proprietary indices and sub-accounts that are supposedly coming out now. And especially, you know, they've all got fancy names and managers are doing all kinds of fancy things like volatility controlled indices and options. It's a big subject, and frankly, it's worth of an entire, you know, webinar kind of almost to itself. But I just wanted to make some very general comments. As these types of accounts are becoming more prevalent, you know, the more prevalent options to select for sub-account or index strategy choices, you have to ask, you know, why are these things being marketed? The likely answer is so that the user or the agent running the illustration is going to be convinced to use a higher constant rate, a higher crediting rate, so that they can show a better illustration forecast. So we suggest that you kind of have a high level of skepticism around what these type of sub-accounts say they can do and what they will actually do over time. They're also usually marketed, you know, promoting a new strategy or a portfolio management team that's going to do a better job than someone else's team, or even versus a passively managed asset portfolio. You know, however, there's been a lot of research that's been done that has looked at the long-term benefits of actively managed strategies, you know, that focus on either security selection or market timing. And the results have generally not shown, you know, a lot of additional alpha created over longer investment horizons, you know, even versus simple benchmark of similar asset portfolios that are not managed at all. So just say that they're there. Yes, there's a way in our tool to mimic what those sub-accounts may look like. But I would just have a lot of skepticism when it comes to them, at least with regard to whether the rate you can use should be higher than what you would normally expect to use for investment.
Good point.
Okay, great. I think that's probably a good place to end. We do have a bunch more questions in the queue, but since we're almost 5 after, I will send all those unanswered questions to Dick and Michael, so everyone will get an answer to their questions.
Yeah, we'll be pleased to do that. Might take us a couple of days, but we'll be pleased to do that.
Okay, great.
Thanks, Shannon, and thanks everybody for attending.
Yeah, thank you all. And just a quick couple quick reminders to our attendees. When you log out of the webinar, an evaluation comes up. If you complete that, we always appreciate your feedback. And that's where those that need accounting credit will enter the 3 CPE participation codes. The last question of the evaluation is where you enter those. And on behalf of the Society of Financial Service Professionals, thank you again, Dick, for sponsoring this webinar. Thanks, Dick and Michael, for the presentations. And thank you to our attendees for your registration and participation. And with that, the conference is adjourned. Thank you.
Thank you. Goodbye.
Thank you. Bye.